what Tesla stock looks like in 10 years if Elon Musk hits its targets, according to Barron.com. What would Tesla stock look like if Elon Musk pulls off and hits all of his performance goals over the next decade, earning him a cool $1 trillion in the process? Now, the answer is relatively simple. Like a magnificent 7 stock, Tesla shareholders recently voted to award their CEO an unprecedented pay package of some 425 million restricted shares. To unrestrict them, Tesla has to sell millions of cars, autonomous driving subscriptions, robo-taxis, and robots. All that must add up to $8.5 trillion in market capitalization and $400 billion in annual earnings before interest, taxes, depreciation, and amortization, or EBITDA. Tesla is expected to generate 2025 EBITDA of about $13 billion from sales of just under $100 billion. That leaves the company's shares trading north of 100 times EBITDA and a more than 200 times estimated 2025 earnings per share. The Mag 7 stocks, excluding Tesla, trade for an average of about 19 times estimated 2025 EBITDA and 31 times earnings, according to Bloomberg. The 6 Google parent Alphabet, Amazon, Apple, Meta Platforms, Microsoft, and Nvidia are expected to generate about $1 trillion in 2025 EBITDA with an average EBITDA profit margin of about 46%. If Tesla were to generate 2035 EBITDA of $400 billion, earning Musk his money, the shares would likely be trading for roughly 30 times earnings net of cash and about 18 times EBITDA. That's very Mag 7-like. Several assumptions are used to arrive at that conclusion, including ones related to cash generation, capital spending, tax rates, and profit margins. Things could and likely will turn out differently. A financial model doesn't always accurately reflect the future. It's only a guide to help investors. In this instance, Barron's model appears to reflect what investors expect. However, shareholders believe Musk can do it. And if they didn't, the stock wouldn't be worth $1.4 trillion today. Can it happen though? Can Musk really pull it off? That's a decision for individual investors to make. Expanding EBITDA 30-fold in 10 years seems impossible. There is some ruling though. Nvidia, for instance, was generating between about $5 billion and $10 billion in annual EBITDA before the explosion in AI computing. Now, Wall Street expects calendar year 2026 EBITDA of about $130 billion and 2027 EBITDA of about $190 billion. If analysts are correct, Nvidia's EBITDA will expand 30-fold in what feels like a blink of an eye. Sky-high demand for AI chips is, of course, why Nvidia is earning more money. Therefore, Tesla investors expect Tesla to take those chips and create AI applications that will do the same for its income statement. Physical AI products are still a long way off, wrote Truist analyst William Stein in a Monday report. The vast majority of Tesla's value is tied up in physical AI technology, such as robots and robotaxis. Yet, all of these projects are quite unproven and close to zero revenue. Stein is skeptical, rating Tesla's shares a whole. His price target, however, is $406 per share, valuing Tesla at more than $1.2 trillion. Elon Musk's $1 trillion pay package at Tesla removes a big overhang that the company's top executive could leave and to develop physical AI products elsewhere. And while the headline $1 trillion value is stunning, Truist analysts say in a research note the compensation package is more about securing Musk's leadership and influencing voting control. We believe Musk's new compensation package is strongly aligned with the interest of equity because it is only awarded if the company achieves both every high market capitalization levels and a series of operational goals. The analyst wrote, "We note that if all of Musk's awards are granted, the share price would be 384% higher than it is today. The stock valuation is increasingly linked to AI initiatives around humanoid robots and robotaxis that aren't bringing in revenue for now." Now, Tesla's Optimus humanoid robot could eventually be worth 80% of Tesla's value, according to CEO Elon Musk. But for now, it's at zero, says Truist Securities. Tesla has made it clear its future lies in artificial intelligence, but William Stein says it's difficult to recommend that investors go all in on the stock, mainly because Tesla has a lot of fine-tuning to do. We continue to see the vast majority of Tesla's future and even current value in the development of physical AI technology, Truist Securities analyst William Stein said in a note to investors. Yet, all of these projects are quite unproven. Stein, who reiterates a hold rating on Tesla stock, estimates that just 22% of Tesla's valuation is related to its revenue-generating automotive and energy businesses. Meanwhile, the AI products that investors are more interested in are a long way off and generating little revenue. Tesla's full self-driving advanced driver assistance system has been available for years in the US and is at the core of the company's RoboTaxi plans. But as of October, only about 12% of Tesla's fleet had the service, which in the US is offered as either a $8,000 one-time payment or a $99 a month subscription. Although Tesla says using its software is much safer than relying on human drivers alone, regulators have repeatedly opened up investigations into the technology. Tesla has also been accused of overstating the software's capabilities and has been sued over incidences in which the technology was said to be involved. Stein said that Truist's own tests last month showed that FSD didn't perform as intended, although he noted that Tesla has been working on improvements. But Tesla will need the software to work flawlessly if it wants to scale its eventually autonomous ride-hailing service, he added. Tesla is currently offering RoboTaxi rides only in Austin, Texas, and in California's San Francisco Bay Area. For now, the company uses Model Y SUVs equipped with FSD and overseen by a safety driver. However, the company plans to expand to another 5 US cities to take the drivers out of Austin and to scale its existing fleet to at least 1,500 vehicles by the end of the year. According to CEO Elon Musk, eventually it also plans to replace its SUVs with designated robotaxis, the Cybercab, which is set to enter production next April. But there are several factors that can impede Tesla's expansion efforts, including regulatory approval, which can vary by state. Furthermore, Tesla will have to compete with a number of rivals such as Alphabet's Google, Waymo. Now, Stein is also concerned about the development of Optimus, Tesla's line of humanoid robots, which Musk said could eventually account for 80% of Tesla's value and eliminate poverty. Tesla's plans to eventually sell the robots for both commercial and residential use. Musk has said investors can expect the demonstration of a third-generation Optimus in early 2026. Production is also set to begin near the end of next year, according to Musk. While it's at zero today, if we expect this will eventually be a general purpose robot combining human-like dexterity with superhuman intelligence, it's quite easy to adopt a view that Optimus could sell millions per year for $30,000 each, Stein wrote. What do you think? Will Elon Musk pull it off? Is William Stein a little too pessimistic about the company trying to warn his investors? Now, let me know in the comments. Thank you so much for watching, and hopefully I will see you in another video. My name is Claudia, and goodbye.